take a look at what else has been making news in finance and economics this week. We're joined by Suzanne Haddan, Managing Director of BFG Financial Services. Suzanne, thanks so much for being with us.
Thank you.
There's a big increase in the number of loans being issued for property. What does that mean?
Well, there has been some enthusiasm getting back into the market, and I think with the low interest rates and the fear of missing out, people are sort of rushing back in to a certain extent, but caution's probably the word to remember there.
New data has shown that house prices are still obviously very high. That's not news to anyone. But the data is showing that it's still better to buy a house rather than to rent a house. Just explain that data.
Well, it's been some interesting data. Take Sydney and Melbourne out of it because there's slim pickings there. But around the rest of Australia, it's certainly showing strong indications that buying would be a better economic outcome than renting. And that's because we've got the low interest rates and we've got the lower property prices. Remembering, you're right, the market has been picking up, but on 12 months it's still down in most places.
What does that mean? What does that mean ultimately in terms of the market? Because we keep having this circular conversation about if you're sitting on a house, then of course you want the price to go up. But if you're trying to get into the market, then you want it to go down. And we sometimes hear that it might actually be better in a market this overheated to just take all of the money that you would have been putting into your mortgage and invest it in the stock market, for example, while you continue to rent. Is that
okay? Well, there's a couple of points there, Josh. The first thing I'd say to first home buyers to give them hope is to really look at strategies to maximise saving for their deposit. And the first is the First Home Super Savers scheme. And that can improve your savings by about 30%. So I strongly recommend those first home buyers talk to their super fund or advisors for that benefit. Plus, look at the state incentives for purchasing a home. They can be $10,000, $20,000. And also a new one coming January 2020 to help people who haven't been able to save more than 5% deposit. The government will guarantee the deposit between 5 and 20%, so they might be able to get into the market, though it's limited on what you can actually buy.
And it's limited to only 10,000 spots, and there are more than 10 times that.
Oh my gosh,
first home purchases in the country. So get in quickly on January 1st if you want to buy it.
FOMO applies in this case, let me tell you.
Because it's tricky. While the data might show that financially you're better off to buy in the long run than you are to rent, you have to at least initially have that lump sum of a deposit, which is not necessarily possible for many people.
It is very difficult, and that's why the $10,000 being offered that benefit from the government probably isn't going to be enough. On the flip side, to Josh's point on how to save for a deposit, when you think about moving your money, say, from a savings account to the share market to save for your home, do so if you're investing for the long term, 5-7 years.
Also, I mean, when you're taking on a loan that you don't know what interest rates are going to be in 15 years' time, right? So, I mean, it's not just whether or not you have the deposit, it's also whether or not you're going to be able to repay the loan if interest rates go up. It's all very well to, you know, you don't want to be taking out a loan where you can only just make the repayments right now, because in 15 years, interest rates could be 8%, they could be 12%, who knows?
That's exactly the case. So the first point there is try to take principal and interest, so at least you're reducing your debt over time. The second point is that the financial institutions lending you the loan should be doing so responsibly, which means they might lend it to you at 4%, they should be saying, can you afford it at 6%? And that was highlighted in the Royal Commission, the concerns around that. I've said before, just because you're offered a loan doesn't mean you should take it.
News from the Reserve Bank this week, they've indicated that there's not going to be any lift in wages anytime soon.
That was really depressing, wasn't it? And it was around many other things that are somewhat concerning in that they're saying our inflation rate probably won't hit that target, you know, the 2 to 3% for a couple of years. We're unlikely to see the type of growth in the economy we were hoping. And the trouble is, this makes people feel that they should be cautious, so they haven't spent their tax refunds, for example.
And just quickly, the tax officers found a shortfall. What's going on in there?
They're good at finding shortfall. This one's about $9 billion, and interestingly, they think one of the key drivers to that shortfall is actually people on the rental platforms, Airbnb and Stays. And what's happening is they're getting the information directly from the rental platform, and there's about 190,000 individuals using this arrangement. And so they're sending letters out to people because people aren't declaring the income, over declaring the deductions. other concern I have is many people don't realise that it can affect the capital gains tax on your home, which normally is free of capital gains tax. My tip there, if you're going to start on one of these rental platforms, you must get a valuation on your property before you commence.
Right, because then it becomes a business in a way.
In a way, it protects the previous gain.
Got it.
Suzanne, thanks for coming in this morning.
Thanks, Suzanne.
My pleasure.